So folks, welcome. Thank you for joining us this morning. We're going to go much deeper into the issues, some of which were alluded to by Xian Yang and Yao Long earlier. Christine, we're going to start with you. We're going to talk about macro. So, massive things we're going to talk about here. Inflation, interest rate movements, investor sentiment in Asia-Pacific real estate markets. So, what are the key capital flows you're observing across APAC? And how are cross-border strategies evolving in response to these?
Okay, I didn't expect that. To start first.
It's the big question. We're going to give that to you.
Thanks, everyone. Good morning. My name is Christine Lee, and I head Asia Pacific Research for Knight Frank, which is a global consultancy, and we look at primary data for real assets. And the first question is pretty big. Of course, over the last 3 years, I think the main theme for the global economy is really high interest rates. And because of that, not just REITs, but real estate asset class basically come under a lot of pressure because it's basically a triple whammy for real estate. Let me explain. The first one is when you have high interest rates, basically your investors demand more returns because they are getting 4% from a fixed income bond, not taking any risks, but your real estate, typically your cap rate returns are just about 4 to 7% across the board. So it becomes unattractive, and a lot of investors basically demand more from the real estate investors. And because of that, you can see a lot of valuations across the board, particularly in places like US, Australia have come under pressure. So there's a lot of repricing of the assets. So basically, when you have free money, like the quantitative easing, you see asset prices appreciate a lot, or they are inflated. But the last 3 years, we really saw the deflation of the asset prices. And on the other hand, when you have high interest rates, actually your tenants are not able to grow that much, so they may not expand in your property. And as a result, they don't pay you higher rent. So sometimes the vacancy rates go up, the tenants leave, and then you have the vacancy risk as well. And the third is that when you have high interest rate, some of the mortgage loans may have to be refinanced at much higher rates. So your asset owners may not be able to hold on to all these assets, and as a result, they have to sell. I mean, just imagine your mortgage rates for your homes. If you bought it at 1% and now you have to refinance it at 5%, how many of you will be hit with extra interest expenses? And because of that, you have to look at ways to finance that, and some of the asset owners will have to sell maybe at a discount. So this is a triple whammy situation. And because of that, we saw a lot of capitals pull back. In fact, 2023, 2024, the only people who are very active in the market are your high net worth individuals, your bright rubies, or some of the billionaires around the world. I mean, we just saw Heidi Lau boss bought 21 Collyer Quay. I mean, it's not heard of, right? Why do you need to buy an office building for hot pot bosses, right? So seriously, I mean, the market has been in the doldrum for a while. But interestingly, just as the last 4 months of 2024, we saw interest rate cycles change. So it really has come down to the level that people feel that real estate is, again, a bit more attractive. Although your benchmark rates are still high, but people are looking at deploying. So over the last 2 quarters, I would say, people start to look at Australian assets, sometimes also UK assets, but because I only cover APAC, so maybe I'll just share the top 3 destinations are Japan, Australia, and South Korea. Japan is a different story. I mean, it has no problem with interest rates because it's basically borrowing at free money. And you have a positive carry because your offices or retail or even hospitality assets are still giving you 4% to 6% yields. So Japan is a market that has boomed over the last 3 years when interest rates were high. But now I think things are changing. So Australia becomes more attractive because your offices are still okay. I mean, with the exception of Melbourne, but some of the secondary cities like your Brisbane, your Perth, even Sydney CBD, despite all these hybrid working arrangements, occupancy rates have been up. In fact, across the whole APAC, you can see the occupancy rates are hovering around 80% versus your 30% in the US, 40% in UK. So really for APAC assets, I think we are quite well positioned. Even for Singapore office, you can see a vacancy rate is hovering around 5%, for prime. So office REITs here, definitely much, much better positioned. And then Australia retail sector is also getting more interesting. The fundamentals are improving. So basically people are looking at experiential retail. So they go back to the malls. They don't just buy stuff from your Shopee, your online e-commerce platforms anymore because everyone wants to go out, right? That's why we have the revenge spending, revenge traveling. And South Korea, again, is a story of the fundamentals. So really a lot of capital is moving around. Singapore is somewhat attractive, but not from the returns perspective. It's more from the safe haven, so diversification. People want to park their money here for wealth preservation. So that are some of the things that's driving, the capital flows around the region now.
Thank you for that, Christine. And that was an excellent overview, folks, about what's happening right now in the region. I'm going to bring it to a more sort of fundamental question for Mr. Chan Kam Kong. So, Kong, I need to ask you about this. For REITs investors, this is something they all need to know. How much do interest rate movements impact REIT performance?
Thank you. And a very good morning to everyone. Now, broadly speaking, interest rate and the REIT's performance, there's an inverse correlation. Let's take a moment just to sort of break it down back to basics. Why is that so? And then from there, you can sort of develop a framework. Now, at the very onset, if you look at the structure of a REIT, just like any corporate out there, you will put in your money to start a company, and that will be equity. And the next component is you will borrow from the bank, and that will be debt. So these are two primary sort of funding that you have to start a REIT. And obviously, when interest rates are high, the portion of the funding would go up. You got to pay more interest payment. That leaves less to be distributed to you as a unit holder. That's at a very basic level because it's just like a corporate structure as well. Next part. REITs during the low interest rate environment has been able to go on a scaling up purchasing asset because the interest rates were lower. It was easier to look for yield accretive businesses or assets in that sense. Now, in this environment, we don't see that. And we are quite fortunate because there was prior to the pain that we are seeing currently, the past 3 years or so, there was a fairly extended period of low interest rates, and the REITs as a cluster has gone up to scale up, and with that, they're better able to weather this current period of storm. The REIT sector has been around since 2000, right? So they've gone through various cycles, but I have to say the last one was quite intense. But they were able to scale up and therefore weather this storm a lot better. Now, if you look back, for the past 3 years, their average distribution yield is still between 6 to 7%. They have held up pretty well. Now, the last one, in terms of the factor about the inverse correlation, there are competing choices as well. One that has been raised was obviously the government bonds. At one point in time, they were very attractive because almost risk-free, and they were giving very high rates, 3.5. But the latest round, it is at about 2.6, 2.7. And I think it's part of the reason why the vibes in this room, as Edward rightly pointed, is quite different from the edition that I came about 2-3 years back. The attendance was different as well. So I think that gives you a sense. So now, with all that three sort of headwinds in the past 3 years or so, as the interest rate cycle, we think is past the peak of it. In fact, in the last edition when we were here, I think we discussed that historically, when we look back, for interest rate from trough to peak, on average, in the past cycles, takes about between 2 to 3 years. And now we're sitting here and says, we are looking back and say, it's about that time, right? And they're trading at a discount of about 0.8 times price to book. So all these factors, as the rate starts to sort of roll over, it will start to peel back one by one. I think a lot of you are here partly because the third factor, which is the competing instrument, now is less attractive. What else? So as you peel back, then you start to see, the attraction of the sort of sector. Thank you.
Thanks very much for that, Kong. Yes, really, the way the interest rates have been moving have, I think, transformed the way we think about investing in Singapore over the last few years. Derek, I'm going to bring you in on this one. So interest rates have been falling, but in recent times, we've had the head of the US Federal Reserve, Jerome Powell, seeming quite reluctant to continue to cut further because he's afraid, for example, of uncertainty and inflation in the US. So what happens to REIT yields and distributions if rates stay higher for longer?
Okay, good morning. Thank you for the question, and good morning, everyone. I just wanted to address this question by breaking down into parts. Okay, so firstly, on a macro front, our house view on interest rates is that there'll be 2 cuts, and that's where the market is pricing in for now. But that interest rates at this moment in time, as my fellow panelists have highlighted, has been a bit of a headwind for the REITs, for everyone. But that is going to get a little bit lesser and less painful, and that is something that is not reflected in current prices. And we believe that in the next 1 or 2 quarters, as you start to see REITs starting to report, we will see increased stability, and you start to see increased optimism that the bottom is seen, or we are approaching somewhat of a trough. So interest rates, while we look at, even if let's say Powell is reluctant to cut interest rates, even if it to bring interest rates a little bit more, the cuts going to come in slower than expected. But the reality is, if you look at where interest rates are now versus say 2 years ago, we are about 150 basis points lower, and it will take time into filtering into the REITs numbers, and this is how it would have a more medium-term impact on your distribution. So what I'm going to say is that the first half of the year may not look as pretty as the second half of this calendar year. The second part that I want to highlight to everyone is that investors generally don't like risk, like ourselves, and how we invest in the journey itself. But I also like to tell everyone is that when you invest, we always focus on the upside. But a lot of people forget, and including myself, is that we need to get comfortable with the risks when you are investing in any particular stock. So for example, at this moment in time, building on what my panelist Christine has mentioned, there are sectors that is impacted a little bit more because of the economic downturn. So for example, in our perspective, office, hospitality, and this cycle, interestingly, logistics and industrial is also feeling a bit of pain because of how Donald Trump is coming up and bringing forth a lot of uncertainty. These are the REITs that are trading at this moment in time at the levels that we felt to be attractive. But in the near term, investors, by virtue of the fact that there's very little visibility, they're hiding in places where we deem to be safer havens. So what are these safer havens? Your healthcare, your retail, your suburban retail, for example. So you'll find that these particular subsectors have held up better than the rest, and it mirrors closely to where we see the fundamentals currently at this moment in time. Then you ask yourself, as an investor, what is your investment horizon? Are you interested that in 3 months' time, I want to make a good increase in price? Or I would like to say that if I were to look 1 year down the road, and when I look back at my investment journey, I felt that I have made a right choice in terms of investing whatever capital you have. So I felt that at this moment in time, for a patient, for longer-term investors, given at how things may be uncertain for now, there are opportunities in the sector as a whole. And I was sharing in our recent reports also is that if we look at how the sector performed at 0.8 time price to book, if you compare this statistic versus what you could get in terms of returns 1 year down the road. Over the past 15 years, at 0.8 time price to book, the observations of a positive return is much higher than avoiding the sector at this level. So what I wanted to say is that, get comfortable with the risk. We know interest rates may be sticky, but it's still going to be on the moderate pace downwards. But if you compare against the past 2 years, I think if you talk to a lot of managers here, you'll find that there are a lot more breathing room compared to a year ago. Okay? And my last message to this particular question is that stock prices generally reflect what potentially the sector prospects will be in the next 6 months. So whatever you invest today, you must, in your mind, hopefully we can inculcate in your investment mindset is that it generally reflects what is happening 6 to 9 months down the road. So always have an eye on the horizon rather than focus on what's happening today. So that's how I would maybe answer that question.
Thanks, Derek. Yeah, so DBS thinks it may be a good time to buy. So we're going to go to Benjamin now. Benjamin, you've been looking at REITs for a long time, so this is not your first rodeo. I'm going to ask you to a sort of a deep dive question. So some REITs are more yield-driven, some REITs are more growth-driven. Which do you think are the better choice? What's a better approach for a REIT to take? And how do we look at that as an investor?
Okay, thanks for the question. So Ben here from SIAS. So going to approach this from more of an investor education perspective. I think the first question you want to ask is basically for yourself. So where are you sitting on the risk-return spectrum, right? So if you're talking about basically yield ETFs, they generally tend to be more stable in price, and that's how they can, generate the yields for you on a consistent basis. But for growth REITs, the assets, of course, will then be invested in slightly more, newer sectors. For example, maybe databases or maybe some retail mall in some third-tier Chinese cities, so on and so forth. So obviously, in that regard, the yields may not be as stable as the yield ETFs, yield REITs, but they are still part of the REIT. So if you want something which is like really low risk, consistent payouts, consistent distributions, then of course you have got the yield ETFs. If you want a REIT that has got a little bit more potential for price appreciation, but at the expense of less consistent yields, then obviously you can go for the growth REITs. But if you zoom out, right, your investment or investing universe is not just REITs. Because if you're super low risk, then of course you can look at bonds, fixed income, right? So you have got good corporate bonds, very stable, like SIA, ST Engineering, so on and so forth. Or you can even look at Singapore government bonds, right? So that's basically risk-free. And then on the other end of the spectrum, if you want something a little bit more oomph to it, right? More growth. Then, of course, you can look at regular stocks. So again, to quote names, DBS, ST Engineering, all these are really great companies. And of course, if you're really the sell-on type, then of course you can look at Tesla or NVIDIA. NVIDIA earnings coming out next week, right? So, the question is, where are you sitting on the spectrum? So obviously, your risk profile tends to be correlated with your age. So the older you get, and if you're retired, then of course you're probably going to be more risk averse. So if you're younger, in your 30s, you've got a growing family, things you want to buy, places you want to visit, so on and so forth, then of course you have the capacity to take more risk. And the growth REITs could be a better fit for your profile. So it depends on where you are in your personal circumstances.
Thanks very much for that, Ben. Next question is, now that we're thinking about REITs, there are different sectors. Not every REIT is the same. So next question is for Christine and Derek as well. I'll start with Christine. Which sectors do you think are currently outperforming from the real assets perspective in Singapore, Christine?
From the real assets perspective, of course, just now I mentioned hospitality, retail, data center as well. I think data center is something that people start to realize, okay, this is maybe for the next 5 to 10 years, because of AI, because of your cloud services, it is really growing. Of course, from the data center REIT perspective, there are also other considerations, other factors that affects your returns and all that. But from the real assets perspective, data center, I would say it's currently my number one choice, followed by hospitality. I think for hospitality is simple because according to our Knight Frank's wealth report, we basically survey all the high net worth individuals across APAC. And half of them are actually spending money on experiences. This is up from 25% 10 years ago. So you can see people are moving away from holding on to material goods, but they want the experience. So whether for the billionaires, maybe they are flying to the spaces, but for us Singaporeans, we always go to Japan for holidays. So all this basically translates into the demand for your hospitality assets. So I just give you some numbers. You know the Marriott brand, the Ultra Lux brand, which is your Ritz-Carlton, over the last 5 years. So from the start of pandemic until now, the revenue or the ADR has grown by 60%, 60, okay, globally. If you're looking at the entire Marriott brand, that includes your Marriott Courtyard, the lower, more economical brand, the overall growth was only 16%, 16. So you can see the gravitation is towards ultra lux. So now we are talking about branded residences, we're talking about Amman Resort, all sorts of experiences that you don't get in maybe the last 5 years, even during pandemic, you don't think about that. But now, even that has become maybe not a fad, but lifestyle choices going forward. So your hospitality assets are going to boom, and I'm looking at the ultra lux segment. And also, it translates to retail demand as well. In the past 5 years, how many pop-up stores have you seen that are from your branded the international brands, like your LV pop-up store in Katong or your Muji Cafe? It's not your usual kind of retail. But when these brands come here to set up their other service lines, not just your branded bags, but they bring the whole experience here, you will see that that's where it attracts the traffic. People actually want to visit those. Marina Bay Sands, they do have a lot of experiential retail. That's why the rents keep going up. Although it's not REITed, but I would like to see it being REITed. You can see how much revenue they bring in for Singapore. And even for retail, in the last 10 years or so, because of internet penetration, e-commerce boom, we do see some of the weaker retailers leave the market. So we do see some vacancy rates are higher. You see places hoarded up. But just now, I think Sen Yang also mentioned when he walked around Suntec Mall, it's a different feel, right? It's much better than a couple of years back. And then you also have your suburban malls. They thrive on your work from home. I don't go to office every day. Sometimes I catch up with my friends or clients in the suburban mall for lunch, and it was so crowded. So I do see people are still visiting those places. In fact, I think the Orchard rents and the suburban mall rents have closed, and the gap has narrowed so much. So there is definitely opportunities in these kind of real assets.
Thanks very much, Christine. Derek, anything to add from the DBS side?
Okay, I look at it from a listed perspective. So I think at this moment in time, you are seeing a disparity in terms of yields and valuations. So by virtue of how investors look at risk once again. So investors are very conservatively positioned for now. And at this moment, we will find that retail and healthcare are trading at premiums versus in relative to sectors that has a little bit more uncertainty. So for example, office, interestingly, hospitality also trading at a steep discount to book, and also other sectors that are offering investors overseas exposure. That is where there's relative value in our view. And I think in the medium term, I think the key question to ask yourself once again is, am I looking to see a 5% increase in my investments in the next quarter? Or am I going to take a more 1 to 2 year investment horizon once again? And then which are the sectors we think that is more upside? I think there's some opportunities in our view in sectors that are trading at a steep discount to book. And then just to add to what Christian has mentioned, people want to spend for experiences. But I would say that hospitality, if you think about Singapore in the medium term, what has the government put in place? T5. T5 is going to double our capacity. And I don't think the government is building T5 to have everyone come and transit Singapore. I'm sure we will want to have more people to come and visit and stay 1 or 2 days. And what you need hotels. And in our view, if Singapore government do not build enough hotels in the next 10 years, we will go into a chronic undersupply. So I think that is something that's interesting for now. And the main reason is also because of the fact that at this moment in time, hotels there's some uncertainty in regards to the near-term outlook. Then if you add in the medium-term prognosis, if we anticipate that there's going to be more demand, and there's more minds coming here, more conventions, Singapore's going to be a more vibrant place, then maybe hospitality in the longer term offers an interesting prospect, I would say. Yeah.
Thanks very much, Derek. Kong, I'm going to come to you for this next question because I'm going to ask you, you're from SGX, so you get to see these things. Do you see a shift in sentiment between the institutional versus retail investors in REITs? So where's the smart money going? Where do you see that?
Okay, we do see some of this in terms of the funds flow, but before getting into that, I thought it would be good to highlight that as REITs, it's a very good diversification tool in one's portfolio. So what we do see, there has been a core group of fans within the insti as well as the retail side of things where this is a core component of the portfolio because it's got a local relation with the other asset class. Now, if you are keen to find out more about this low correlation, you can look up REIT's website or SGX website, or you can go to a Telegram channel, SGX Invest. The latest report was just out yesterday, so you can kind of look through that and see the correlation ratio. Now, coming back to your question, if you look at fund flows, at the margin there are movements, but for retail, it has been quite consistent in the past 3 years. 22, 23, 24, we're talking about net inflow of 1.4 billion, 800 million, and then as of last year was about 1.6 billion. So it has been fairly consistent, so the fan base has grown to a certain extent, right, on the back of that. For institutional, I wanted to take a look at a data point on this, would be the secondary fundraising, which is less talked about. These are the cases whereby the REITs, when they need to do a fundraise, they go to, they have a placements with institutional investors, right? So that's, Derek will be very familiar with that. So now, just to give you some numbers on the back of that, in last year, it was close to 3 billion of secondary fundraising that was done. The year before was about 2 billion. So that shows you the appetite, despite the rates and so on and so forth, and some of the headwinds on growth. There is still appetite from both segments, but at the margin, there will be shifts, from time to time, depending on the events. Yeah, thank you.
Thanks very much for that insight. It's something we don't get to hear. You don't know where all these institutions, where all the smart money is flowing. So thanks for that, Kong. Benjamin, we're going to come to you. So Ben, we alluded to this earlier in the first session. People are looking at REITs now because yields are falling. For example, for T-bills and Singapore bonds in fixed deposits, they're also falling. So what are the current yields like for S-REITs? And what can we look forward to in the coming year ahead? Okay.
So there are so many REITs. If you use the Lion Phillip S-REIT 20 ETF as a proxy, right? The historical yield right now is about 6%. Indicative is about 5.8-ish, right? So 6% is in sync with the range that Kong mentioned just now, 6 to 7. So historical yield right now is about 6% for S-REIT20 ETF. If you compare that versus the Singapore government bonds, Singapore government securities, the latest issue was issued actually last month, end of February. So the coupon rate was 2.75%. It was sold at a slight discount. So the actual yield, if you actually bought that bond during the book building process, the IPO of the bond, right, you have probably gotten about closer to 2.8%. But the bond since then has now risen in price, so it's no longer sold at that original price. It's more expensive. So if you buy today, the yield you're going to get for the Singapore government bond is going to be closer to 2.5%, 2.48%. Okay, so as you can see, S-REITs as a whole, yield is 6%. Singapore government bond is 2.48, sorry. There's a huge disparity. So from a purely yield perspective, then of course S-REITs are best. But the other shoe that's going to drop is of course the risk, right? So Singapore government bonds are basically risk-free because it's a government bond. Of course, this is Singapore, not US, which lost its last AAA rating, or how those guys are, right? So of course, it's risk-free, right? But for REITs, there's of course price movement. Now, what I can say is, obviously, because where we are at a cycle, REIT prices generally right now are cheaper than what they were, 6 months or a year ago. Like if you look at S-REIT20, I think the high was about 90 cents in September. Right now, it's trading about 76 cents for the REIT ETF. So, if you want to diversify, you don't know what REIT to buy, then obviously this could be a product that you want to take a look at. But if you know what you want, and as you listen to Christine, so retail could be something, suburban malls. If you listen to DBS, then of course healthcare, and I've always liked healthcare because it's one of those sectors where you will never negotiate price with a doctor. Doctor say you sick, then must pay lah. What? You're going to say, wait, I go and check the doctor first, I check price. No lah, you pay, right? And of course, it's a very close, regulated industry. Not everybody can become a doctor. So I love that kind of sectors where there's a lot of economic moat. It's hard to lose money unless you're total screw up and you're running a company called Tesla. So that's a totally different thing, right? So if you are, familiar with what sectors in the REIT world they are interested in, then of course you can forget about the S-REIT20 ETF and then you can just go forget, right? The last thing I want to say is, of course, we're talking about REIT, real estate. So what are the 3 most important things for real estate? Location, 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 right? So of course, in our world, when we talk about location, we also talk about the type of REIT. Is it healthcare? Is it commercial? Is it office? Is it mixed use? Is it retail? So on and so forth. So if you have got a certain view and you look at where we are in a cycle, then of course you can go for that particular REIT. And if you don't like the ones which are in Singapore or have assets in Singapore, you have got SGX listed REITs that have got assets in China, in Thailand, or so on and so forth. You can just go for those, right? So it's a good thing to kind of understand where you are in terms of your risk profile and to see what sectors you're interested in.
Thanks very much for that, Ben. So, folks, we're going to move on to the next question, which is we're going to zoom out and look at the rest of the world. Lots of things affect REIT prices and REIT performance. So we're going to talk about the geopolitical and macroeconomic factors. Basically, Christine, I'm going to start with you. What are the things in the news that you're watching with regards to REIT performance?
I think geopolitics is one thing. When we heard the Trump's April Fool's Day announcement, obviously the market is in shock. Although now we have the 90-day truce, I think the sentiment has been affected. I mean, today as a tenant, I'm paying rental every month. Am I going to commit to a 5-year lease with this landlord? Or do I think that my business are going to be affected and I'm not going to do anything rather than renew? That has been the conversation really we are hearing from the market. So I went back to Trump 1.0. At the time, they also started this trade war with China. And we looked at the data, and true enough, tenants' behavior changed. and they basically leased less. So on the APAC level, we actually saw a 30% pullback in terms of leasing volume. So you can see that that actually translates to how much income can a landlord get. Because if the whole market doesn't have enough volume to support, some landlords, especially the weaker ones, definitely will come under some pressure. Another thing is when I look at all these markets, other than geopolitics, is also sector fundamentals. You can look at some markets versus others. Why is Singapore always more attractive than Malaysia? Because on one hand, you can say, oh, Malaysia has all the right ingredients, but look at the oversupply situation. At some point when I was doing my research, I almost thought that my analyst made a mistake of adding one more zero to the supply pipeline. And then when I checked, I realized, no, they really do have so much supply, whether it's in office, whether it's in retail, residential. Good luck to those who are still very interested in JB. Okay, so basically the market is just oversupplied. Maybe with the exception of data center now, because Singapore government says, okay, no more data center for the next 5 years. So everyone went to Malaysia. So Malaysia data center is booming, which is good for the landlords because they have no other sector to go into without an oversupply situation. So basically, you really have to look at some of the fundamentals of the underlying assets. And another thing is the macro trend. I mean, do you want to invest in an asset that's backed by mostly US office REITs? You know, the US people don't go to the office anymore, right? It's commute 1 hour to the office, but they realize there is no retail on ground floor anymore because they have all died during COVID. So basically, the office building is a mono-use, and that sort of deterred people from going back to the office. So a lot of things are still, evolving. Apart from interest rates, I think these are the factors that I look at. Yeah.
Thanks very much, Christine. Derek, anything else from your side that you're watching that you'd like to add?
Okay, I guess all of us are looking at fairly similar data points, but I'll answer this question with a question that was asked to me by an investor. So in my role, I service the institutional investors and also retail and private banking clients. So I had this conversation a couple of years ago. So the client asked me, Derek, can you tell me which REIT I can buy and invest for 10 years, buy and sleep, and ensure that every year I get paid. And at the end of 10 years, I'll make good profits. 3 years ago, I felt that I could potentially name fail names, but I felt that was a little bit irresponsible. And the main reason is because the world changes so fast. And what I wanted to say is that when you invest in any particular REIT, always, or investment, whatever it is, always do a regular check-in of your initial investment thesis. So what I want to say is that if you look at what's happening in the world today, there are stuff that impact, there are data points that impact on a very short-term basis, and there's also some that impact more structural. So i.e., for example, you're invested into a particular REIT, and in the near term, impacted by interest rates, impacted by trade flows, impacted by the fact that economies are going downturn. The quick question you should be asking is this going to be long-term? Does it mean that the tenants of today will not be there tomorrow? If that's the case, you should sell. Then again, if not the case, if that is not the case, and if the stock price has dipped 10, 20%, then you ask yourself, if nothing's going to change in 6 months, why should we be trading at a discount? So I think this is the thing that it's a bit, I didn't really answer that question, but this is the mindset that I would hope, investors, when you look at the REIT, always do a regular check-in and bucket the news flow into cyclical and structural. And if you see more structural issues happening to any particular, be it positive or negative, into any particular investment you have, then ask yourself, should I still be invested there? So at this moment in time, we are seeing that a lot of the news flow that you're seeing are largely cyclical in nature. In 6 months, we hope that we get clearer visibility, and the sector should be trading at this level. Yeah, that's how I see it.
Thanks very much, Derek. Words of wisdom there from Derek. You buy a stock, you're effectively buying it every day, right? That's what some people have said, because your money is there and it's going to move with the price of the stock. And if the stock is going to be affected by certain things, yes, we should keep an eye on things. So thanks for that, Derek. Kong, I'm going to come to you, and then we're going to end off with Ben. So Kong, what are you watching in the markets now, or in the news right now? And what do you think REITs investors should be focused on?
If coming back to the basics, two things. One will be, I think interest rate will still be the key sort of driver. Now, the other one is a little bit, I suppose, when the uncertainty tails off, I think that's where businesses will start to make decisions, commit, because they can't commit now because of the volatile conditions out there. So when you have that level of certainty, I think things will kickstart again. Yeah, those are the two key areas.
Thank you. Yeah, so the uncertainty has really been such a big drag on the markets. People are uncertain, people are afraid. Ben, you're going to have the final word on this. What are you watching? Are there things that you feel that we haven't mentioned that investors should be looking out for?
Well, the two big things will obviously be the how the tariff war is going to wind down or going to continue. Then the other one will, of course, will be the inflation/interest rate environment. Right. So there will be two big things. All of us are looking at that. So what I want to say, and of course, since I'm the last speaker, I'm going to take some liberties here. I'm going to end on a positive note. Okay, I'm going to scan around the room and look for people with more white hair than me. You guys remember Ronald Reagan? Right? You guys remember Alan Greenspan? That was the 1980s, right? If you compare that era versus our era, we are in kindergarten. That era, 1980s, had what? Iran-Contra war, Iran-Contra scandal. You got Vietnam War. You've got the oil shock, Middle East war, right? Hostages in the U.S. embassies, kind of crazy stuff, right? And how high was inflation? Now U.S. talking about inflation, 5%, 4%. That is kindergarten. Right? When Alan Greenspan came in, he raised interest rates to double digit, almost 20%, right? So whatever economic turmoil we're going through right now, don't worry, it's not the end of the world. The flip side is, of course, things are cheap. REITs are cheap. COE prices coming down, but still quite high lah. Right? So if you find a good asset, you got cash lying around, don't worry, the world will still be here in 10, 20 years. Okay? So it's fine. It's going to be fine. All right? Play the long game.
Thank you very much. That's all the time we have. Mr. Benjamin Goh, Mr. Chan Kam Kong, Mr. Derek Tan, and Ms. Christine Lee. Please give them a big round of applause. Thank you for joining us here today.